Last year, resilient global growth was led by the US. Growth in the US surprised significantly to the upside and was revised higher throughout the year and should come in around 2.5%. On the other hand, inflation cooled off quicker than expected in the second half of the year. Labour markets remain tight but are easing as vacancies fall, even as unemployment remains low. We have seen cooling wage growth and labour demand till date without an increase in the unemployment rate, which is historically unprecedented. Even the quits rate has normalized without an increase in the layoff rate. Similarly, on the inflation front, 6-month annualized core PCE inflation is already sub 2%, allowing the conversation to shift to the timing of rate cuts. In fact, Fed Chair Jerome Powell acknowledged the softer inflation prints, and the dot plot projects 3 cuts this year. Financial conditions, therefore, have eased significantly over the last 2 months, led by a large fall in bond yields and a rally in equity prices, which should support growth this year. China wholesale prices have tended to lead US inflation and suggest further cool down in inflation going forward. Money supply is normalizing and Fed's balance sheet is still shrinking as quantitative tightening continues. Household balance sheets remain healthy and fiscal policy is still accommodative. We believe that US growth should slow this year but will remain resilient at around 1.7%. US bonds sold off aggressively this year until October before a massive year-end rally left us unchanged for the year as a whole. We turned bullish on US Treasury bonds when yields jumped to 5% and we launched 2 US Treasury focused products. Since then, US rates have rallied swiftly and we were able to capture this rally. Markets are now pricing in aggressive rate cuts from the Fed. US bonds are a buy on dips market now in our view, as large easy valuation gains are in, but there is still scope for yields to gradually move lower from here. We think somewhat slower growth and to handle inflation will give space to the Fed to cut rates by 100 basis points in 2024. However, risks are more evenly balanced now. Our base case is for the US 10-year Treasury bond yield bottoming at around 3.5% in 2024. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।